Let's talk about why accounting information is important. The objective of this section is to explain why accurate accounting information and audited financial statements are important. Accounting is the process of systematically collecting, analyzing, and reporting financial information. Although accounting information can be used to answer questions about what has happened in the past, it can also be used to help make decisions about the future. To improve the accuracy of their accounting information and financial statements, businesses rely on audits conducted by accountants employed by public accounting firms. An audit is an examination of a company's financial statements and the accounting practices that produce them. The purpose is to make sure that a firm's financial statements have been prepared in accordance with generally accepted accounting principles, or GAAP. GAAP has been developed to provide an accepted set of guidelines and practices for U.S. companies reporting financial information and the accounting profession. The Financial Accounting Standards Board, or FASB, which establishes accounting standards for U.S. companies, is working towards establishing a new set of standards that combines GAAP with the International Financial Reporting Standards, or IFRS, to create one set of accounting standards that can be used by both U.S. and multinational firms. Created by the International Accounting Standards Board, IFRS are used in more than 100 different countries around the world. For multinational firms, the benefits of global accounting standards are huge because preparing financial statements and accounting records that meet global standards save both time and money. Although an audit and the resulting report do not guarantee that a company has not cooked the books, it does imply that the company has followed GAAP. Without the audit function and GAAP, there would be very little oversight or supervision, and the validity of a firm's financial statements and its accounting records would drop quickly. Firms would find it difficult to obtain debt financing, acquire goods and services from suppliers, find investor financing, or prepare documents requested by government agencies. To help ensure that corporate financial information is accurate, Congress enacted the Sarbanes-Oxley Act in 2002. Key components include the following. The Securities and Exchange Commission, or SEC, is required to establish a full-time, 5-member federal oversight board that will police the accounting industry. Chief executive and financial officers are required to certify periodic financial reports and are subject to criminal penalties for violations of securities reporting requirements. Accounting firms are prohibited from providing many types of consulting services to the companies they audit. Auditors must maintain financial documents and audit work papers for 5 years. Auditors, accountants, and employees can be imprisoned for up to 20 years for destroying financial documents and willful violations of the securities laws. A public corporation must change its lead auditing firm every 5 years. There is added protection for whistleblowers who report violations of this act. While most people welcome the Sarbanes-Oxley Act, complex rules make compliance more expensive and time-consuming for corporate management and more difficult for accounting firms. Accounting usually is broken down into 2 broad categories, managerial and financial. Managerial accounting provides managers and employees with the information needed to make decisions about a firm's financing, investing, and operating activities. Financial accounting generates financial statements and reports for people outside an organization, such as stockholders, financial analysts, bankers, lenders, suppliers, government agencies, and other interested groups. Additional special areas of accounting include the following. Cost accounting is determining the cost of producing specific products or services. Tax accounting is planning tax strategy and preparing tax returns. Government accounting is providing basic accounting services to ensure that tax revenues are collected and used to meet the goals of state, local, and federal agencies. Not-for-profit accounting is helping not-for-profit organizations to account for all donations and expenditures. Accounting can be an exciting and rewarding career, one that offers higher than average starting salaries. To be successful in the accounting industry, employees must be responsible, honest, and ethical, have a strong background in financial management, know how to use a computer and software to process data into accounting information, and be able to communicate with people who need accounting information. Accountants generally are classified as private or public accountants. A private accountant is employed by a specific organization. A public accountant works on a fee basis for clients and may be self-employed or be the employee of an accounting firm. Typically, public accounting firms include on their staffs at least one certified public accountant, or CPA. A CPA has met state requirements for accounting education and experience and has passed a rigorous accounting examination. State requirements usually include a college degree or a specified number of hours of college coursework and from 1 to 3 years of on-the-job experience. Details regarding specific state requirements for practice as a CPA can be obtained by contacting the state's Board of Accountancy.